Why do prices sometimes detach from reality and continue rising long after they should stop? Why do investors ignore obvious risks and embrace the same narrative? Throughout history, bubbles have repeatedly appeared and disappeared. Today, we explore this fascinating phenomenon through the lens of econophysics. In healthy markets, price and value move together. Value is rooted in fundamentals such as earnings, assets, and future prospects, while price reflects what people are willing to pay. Most of the time they remain aligned, but bubbles begin when price starts drifting away from underlying value. A bubble emerges when market prices rise far above fundamental value and remain disconnected for a prolonged period. Expectations become unrealistic, narratives overpower evidence, and momentum drives further buying. The market stops measuring value and begins feeding on belief, optimism, and speculation. Bubbles follow a recognizable pattern. They begin quietly, grow through optimism, accelerate into mania, and peak in euphoria. Eventually, warning signs appear, denial sets in, panic follows, and prices collapse. Different eras and different assets may change, but the underlying dynamics remain remarkably similar. Bubbles captivate us because they are deeply human. They promise opportunity, wealth, and the possibility of a better future. They appeal to hope, ambition, and imagination. At the same time, they reveal our tendency to follow crowds, chase success, and underestimate risk. The real puzzle is not simply why prices rise. It is why collective belief becomes stronger than reality itself. During a bubble, expectations, narratives, and emotions begin to dominate decision-making. Understanding this requires viewing markets as complex systems shaped by feedback and human behavior. The Econophysics Lab is an initiative of physical sciences consultorium dedicated to understanding markets through the tools of physics. By studying patterns, systems, networks, and complexity, we seek to uncover the hidden dynamics behind financial phenomena and make scientific thinking accessible to everyone. At the heart of every bubble lies a powerful mechanism known as positive feedback. Rising prices attract attention, attention attracts buyers, and new buyers create even higher prices. Unlike a stabilizing system, the output reinforces the input. Bubbles are not random events, they are feedback systems operating in overdrive. When prices begin rising, people notice. Higher prices appear to validate the investment story, creating a sense of opportunity. Fear of missing out, social validation, and growing confidence attract new participants. Rising prices change perception, and changing perception brings even more buyers into the market. As more people enter the market, demand increases. In the short run, supply often remains limited, so prices must rise. Higher prices then attract additional buyers, creating a reinforcing cycle. What begins as a small increase in demand can quickly evolve into a powerful upward trend. A bubble grows through a self-reinforcing cycle. Prices rise, confidence grows, more buyers enter, demand increases, and prices rise further. Each step strengthens the next. The loop continues feeding on itself until confidence weakens, demand fades, or reality finally interrupts the process. As prices continue climbing, momentum begins to dominate decision-making. Investors focus on recent gains rather than long-term value. Media coverage increases, social proof grows stronger, and fear of missing out accelerates participation. Momentum feeds on itself, making the trend appear unstoppable, until it suddenly isn't. Bubble prices do not simply rise, they accelerate. Each increase builds upon previous gains, creating a compounding effect. Growth appears slow at first, then rapidly becomes explosive. History shows the same pattern repeatedly. Tulips, dot-com stocks, housing markets, and cryptocurrencies all experienced exponential surges before reality intervened. One of the central ideas in physics is amplification. Small disturbances can produce enormous outcomes under the right conditions. In markets, a tiny signal can trigger feedback, spread through participants, and grow into a massive price movement. The same forces that amplify the rise also amplify the eventual collapse. Human beings are not purely rational decision makers. We constantly observe, imitate, and learn from others. In uncertain situations, the actions of the crowd often feel like valuable information. In financial markets, this social tendency becomes a powerful force, transforming individual decisions into collective movements that can drive prices dramatically higher. When people see others buying, they often assume those investors possess better information. Following the crowd feels safer than standing alone. As more participants imitate each other, buying becomes self-reinforcing. History repeatedly shows that bubbles grow not because everyone is informed, but because everyone is watching everyone else. As prices rise rapidly, many investors stop asking whether an asset is worth buying and start worrying about being left behind. This fear of missing out, or FOMO, creates urgency and emotional decision-making. People buy not because the opportunity is attractive, but because the alternative feels unbearable. Ideas, emotions, and behaviors spread through social networks much like a contagious disease. Excitement can travel from person to person, influencing perceptions and decisions. The more people adopt a belief, the more credible it appears. In bubbles, optimism spreads rapidly, creating a powerful social contagion that fuels market participation. Markets run on stories as much as numbers. A compelling narrative can simplify complexity, inspire belief, and unite large groups of people around a common vision. As a story spreads, belief strengthens, participation grows, and prices rise. Eventually, the narrative itself becomes a driving force behind the market. At the peak of a bubble, excitement becomes euphoria. Confidence appears limitless, skepticism fades, and risk is ignored. Investors begin to believe that extraordinary gains are normal and that the future can only improve. Ironically, this moment of maximum optimism is often the point of greatest vulnerability. In the final stages of a bubble, prices are no longer anchored to fundamentals. Instead, they are driven by collective belief and crowd behavior. The market becomes a reflection of shared emotions rather than underlying value. When the crowd determines reality, prices can rise spectacularly, but they can also collapse just as quickly when belief disappears. Every bubble begins quietly. Long before headlines appear and crowds arrive, a small group of informed investors notices an opportunity. They see strong fundamentals, future potential, or a market inefficiency that others overlook. Smart money does not create the bubble. It simply positions itself before the rest of the market notices. As awareness slowly grows, early adopters begin taking positions. These investors are comfortable with uncertainty and willing to think independently. The idea remains unpopular, trading volumes are low, and few people are paying attention. Yet this stage is crucial because the foundation of the future bubble is quietly being built. Eventually, the story reaches a wider audience. News outlets, social media platforms, influencers, and online communities amplify the message. Attention creates legitimacy, and legitimacy attracts participation. What was once a niche idea becomes mainstream. In markets, attention acts like fuel, accelerating both interest and price appreciation. Mania begins when excitement replaces analysis. Prices rise so rapidly that skepticism is dismissed and risk appears irrelevant. Investors become convinced that the old rules no longer apply. Stories of easy wealth dominate conversations, and the belief that this time is different spreads throughout the crowd. Euphoria is the emotional peak of the bubble. Confidence is absolute, gains seem effortless, and risk feels non-existent. Everyone appears to be making money, reinforcing the belief that prices can only move higher. Ironically, the moment of maximum optimism is often the moment when the market becomes most fragile. When prices finally begin falling, many investors refuse to accept that the bubble has burst. They call it a temporary correction, blame outside events, or convince themselves that a recovery is imminent. Denial delays action and often transforms manageable losses into devastating ones. Reality has changed, but belief has not. Eventually, denial breaks down and fear takes over. Investors rush to sell simultaneously, liquidity disappears, and prices collapse. Selling triggers more selling, creating a downward feedback loop. Panic is the mirror image of euphoria. Emotions dominate decisions, and rational thinking becomes increasingly difficult as markets unravel. The final stage is capitulation. Hope is exhausted, confidence is shattered, and investors sell at almost any price simply to escape the pain. Ironically, this is often when the bubble reaches its true bottom. After maximum despair comes stabilization, and from the ruins of the old cycle, a new one eventually begins. As a bubble grows larger, it also becomes more fragile. Valuations stretch beyond reality, leverage increases, risks are ignored, and prices become dependent on a constant stream of new buyers. The structure may appear strong from the outside, but beneath the surface, vulnerabilities accumulate. Fragility grows silently until the system can no longer absorb stress. Leverage allows investors to control large positions with relatively little capital. During a rising market, it magnifies gains and creates the illusion of easy wealth. However, leverage works both ways. When prices fall, losses are amplified just as quickly, turning a manageable decline into a potentially catastrophic collapse. Every bubble eventually reaches a critical point, a tipping point where stability disappears. Before this moment, the system can still absorb shocks and continue rising. After it, the same forces that pushed prices upward begin driving them downward. The exact timing is unpredictable, but once the critical point is reached, everything changes. Contrary to popular belief, bubbles do not require a major event to burst. Once a system becomes fragile enough, even a small trigger can set off a massive reaction. A disappointing earnings report, a policy change, or a shift in sentiment may be enough. The trigger is small, the vulnerability is not. Markets are highly interconnected systems. When one part begins to fail, the effects spread throughout the network. Falling prices trigger selling, selling reduces confidence, confidence loss creates more selling, and liquidity begins to disappear. Like a row of falling dominoes, one failure leads to another until the entire system is affected. A crash is not simply a price decline, it is a rapid breakdown of market structure. Fear replaces confidence, selling accelerates, liquidity vanishes, and volatility explodes. Feedback loops reverse direction, causing declines to reinforce themselves. The faster prices fall, the more investors panic, making the collapse even more severe. In the end, the bubble is revealed for what it truly was: a collective illusion sustained by belief. As confidence evaporates, prices reconnect with reality. The hype disappears, optimism fades, and the party ends. What remains is a valuable lesson about markets, human behavior, and the consequences of ignoring fundamentals. Market bubbles are not random events. They emerge naturally from the interaction of feedback loops, human behavior, and systemic instability. As expectations reinforce actions and actions reinforce expectations, a self-sustaining cycle develops. Understanding bubbles means understanding how complex systems evolve, and why periods of extraordinary growth often contain the seeds of their own collapse. Complex systems have the ability to amplify small changes into major outcomes. Rising prices attract attention, attention builds confidence, confidence attracts investment, and investment pushes prices even higher. This positive feedback transforms gradual change into rapid acceleration, creating the conditions under which bubbles expand far beyond their fundamental foundations. The goal of econophysics is not to predict the exact future but to recognize emerging patterns. Markets are too complex for precise forecasts, yet they often display recurring structures and warning signs. By observing behavior, understanding dynamics, and identifying instability, we can anticipate risks without pretending to know exactly when a bubble will burst. Bubbles reveal themselves through characteristic signals: parabolic price growth, herd behavior, rising volatility, stretched valuations, and excessive liquidity. These indicators do not guarantee an imminent collapse, but they suggest that the system is becoming increasingly unstable. The focus is not on predicting the crash, but on detecting the risks that make one possible. Markets are fundamentally human systems shaped by psychology, incentives, narratives, fear, and social influence. Prices emerge not only from economic fundamentals but also from collective behavior. To understand booms, crashes, and bubbles, we must study the interaction between people and markets as a single complex adaptive system. The next episode explores one of the most fascinating concepts in complexity science, power laws. From wealth distribution and company sizes to internet networks and market returns, power laws explain why a few entities dominate while the majority remain small. It is a hidden mathematical pattern that appears throughout nature, society, and economics. If you found this exploration of market bubbles insightful, support the journey by liking, sharing, and subscribing to Physical Sciences Consultorium, PSC. The Econophysics Lab series is dedicated to making complex ideas accessible through the lens of physics. Join us as we continue uncovering the hidden patterns that shape markets, systems, and the world around us.